Welcome to my stock market news channel. Today we'll discuss about banking fundamentals part 2. Here welcome friends. Today we'll discuss about the banking fundamentals and overview related with tools and basically the outline of what is fundamental analysis, tools used for fundamental analysis, how to perform banking stock analysis, interest income, NIM, NII, cost to income ratio, net profit. These all are the outline. And first of all, you have to know why you require this all fundamental analysis. Basically, in that analysis, we'll easily conclude about the bank's financial conditions, whether the bank is in a bankrupt situation, is a bank is a weak situation, bank is sick situation, bank is very good situation, is a full is a excellent in future, it can give you more return. So before investing in any banking sector, you have to study all the tools. We have to know very well about the tools. Today I will just overview, and next all videos I will describe each and every tools one by one clearly. Basically, the banking business is different from other businesses, so we need to look at different parameters to perform basic banking stocks analysis. Bank's primary business is to give out loans to different customers and charge interest on the loans. Banks also have other fee-based businesses like credit cards and debit card services, transferring money, insurance, mutual funds, etc. These all are fees-based businesses. Fine. Now we come to the point, that is, what is fundamental analysis? Fundamental analysis is just calculate the fair market value of a bank. And what is fair market value? There is two values present. One is the current market price or the present value or the market value, and another is the exact value or actual value. Maximum cases actual value, it cannot be the same as current value. So naturally what's happened in fundamental analysis, we will know the exact value is what and how much we are paying for a particular stocks. Just for example here, before going to example, I am telling you one thing. Fundamental analysis search for stocks currently trading at price higher or lower than the real value. If the fair market value is higher than the market price, the stock is deemed undervalued and a buy recommendation is given. If the fair market value is lower than the market price, the stock is deemed overvalued and the recommendation might be not to buy or sell if the stock is held. In contrast, technical analysts favor studying the historical price trends of the stocks to predict short-term future trends. What's happened, I am telling you now. Anytime, just for example, a particular bank's actual price is ₹10 and the market price, that means the current market price presently is CMP is 12. That means you have to pay ₹2 more than the exact price. So this is overvalued. In some cases, if the value is 8, then you will easily conclude it is undervalued. So how we know the exact value? Just for example, there's a lots of items there, but I am just for example giving you a short way. Suppose a bank's all the assets are calculated, all assets, everything from starting from a chair, tables, fan, air conditions, vaults, everything what it have, minus all the liabilities like debts. Like debts means, liabilities means all the deposited amount they have to pay. Payable interest amount, all have to payable interest amount that is have to pay bank. This all the liability for bank. So naturally you have to minus all the things. And what is get is this is the interest value, right? And total value divided by the shares, outstanding shares. So this is the exact value of a particular bank stocks, right? This is the actual value. But now customers, the shareholders are expecting more. This is the future value, right? This future value increases the stock's value. This is the different. This is the reason, because the real value is not equal to the actual value. So the actual value is 12 presently, and the present value of a bank is say 10 rupees. So this is not actually the exact fair market value. This is not intrinsic value is not same, but that stakeholder, the shareholder, those are interested to buy, expecting in future the bank will do more. For this reason they are ready to pay rupees 2 more, and when the bank is completed after a year, after a quarter, and it is proved that it is really doing better job, naturally the market price will never be the same as actual price. So this is fundamental analysis we will easily calculate. At least we will try. This is not so easy to calculate exact values of all everything, because there's a lots of ratios as there. Those are not calculated through simple Excel sheet, but at least we can guess, we can just conclude it at a certain point how much strong a banking sector, particular bank, and it is of course we can, through some metrics we can easily conclude that is true. Next, the tools basically used not only for the banks, these tools used for every or any sector, any industries. One is EPS, second is PE ratio, third is return on equity, fourth is price to book ratio, fifth is beta, next is price to sales ratio, next is dividend payout ratio, and last one dividend yield ratio. These are the tools through earning per share, particularly how much a company is ready to, how much they are ready to pay. Suppose company total profit divided by outstanding share, this is the EPS, and it helps investor understanding whether whether the particular company is profitable or not. And the EPS indicates how much money a company or bank makes for each share for its stock, and is a widely used metric for estimating corporate value. A higher EPS indicates greater value because investor will pay more for a company's share if they think the company has higher profits relative to its share price. This is earning per share. Now the price to earning is PE ratio. It is also another ratio, price to earning, how much price it is paying divided by what is the earning. Next is return on equity. Return on equity is another important stock, and another important ratio. Return how much return is getting, and price to book value is the PB ratio. This is also important. This is how much price original divided by the original book value. If the price to book value is price to book value is if the price is higher than the book value, that means price to book value is high, and if the PB ratio is high, that means you have to pay much than what is the exact value. Beta, there is a alpha and beta. Beta is slow growth companies, slow moving companies is the beta. So long, I will give each and every point tools I will discuss somewhere another video. Price to sales ratio, this is for everything, how much price is paying and how much it is sales. Dividend payout ratio or dividend yield ratio, all. Next is tools for FA or financial fundamental analysis for banking stocks. One is interest income, how much a bank interest is incoming from particular total interest paying, and suppose just for the customer deposited amount in a bank, this is a liability for bank because you have to pay, bank have to pay. Same with the assets are the, when the bank disburse some loan, and the assets are those are interest amounts assets, and the net interest income means the total assets minus total expenses, and net interest margin is NII divided by relative values. Relative values means relative assets. This is called the net interest margin. I already defined another video or thing. Cost to income ratio, how much is cost and divided by total income, and net profit ratio. Return on assets, how much return, how much assets getting from a particular stocks, and return on equity. I already told. Total advances, how much, total depositors, how much, credit CD ratio, how much credit already bank given divided by total deposits amounts. This is a calculation process to know the exact structure, exact status of a bank. And next, the casa ratio. This is a current deposit, how much amount is there. Casa ratio is because suppose the customer's deposited amount to a bank, and he may deposit it as a fixed deposit like term deposit. Say the customer also amount can be deposited in a current account. Current account, casa means the current and savings account. The total amount deposited, current and deposit amount. Current deposited account in that type of accounts, when the customer deposited amount is a low cost, but when because bank don't have to pay anything, because the current account holders are not paying any interest, you know. So for this reason, this is a low cost deposited and bank don't have to pay anything. The same way, if the customer is don't deposited the amount in current, better he deposited in the fixed deposit, bank have to pay much more interest. So this is a casa ratio will calculate it, and it will give us how much the present scenario of a bank. Next, the GNPA and NPA, and we know the what is called the NPA, and when after 90 days a particular asset become NPA, and when it is become NPA, then you have to give some provisions on it. And GNPA and gross NPA is the total NPA of a bank. After 90 days it become NPA, everything, how much money is after, if any loan, if completed 90 days, it's completed, it is now in GNP. But NNP is not that. NNP is much lesser than the GNP. NNP is the actual loss of a bank. I already created another video, and I already described everything there. Please look at the list and you will find out NPA. Provision coverage ratio, this is a PCR ratio. When after an NPA, after a particular asset become marked as NPA, bank have to provision on it. Bank have to provision on it from his profits, and that means profit is declining, and bank have to make some provision. And when the provision is 100% for a particular loan's NPA amount, then if the loan is marked as actual loss or perfect loss or completely lost assets, then the provision if is 100%, then bank don't have to bother about it. So PCR is another good ratio. If PCR is positive high, then there is no tension about the sector bank. Now the capital adequacy ratio, how much capital a particular financial institution, NBFC or banks have. This is a CAR calculated through Tier 1 capital plus Tier 2 capital divided by risk weighted average assets, and this is the Basel 3 norms, and I will define this somewhere. I will create another video on it. Next, come to the how to know the exact banking sector situations through annual report. What is the bank actual annual reports basically defined? What is the bank's actual loss? It is price, it is earning power, the amount of risk it's taking to achieve the earning power. Annual report defined bank's actual loss, how much banks is presently losing, or it is exact price, it is earning power, how much earning power it is, and the amount of risk it taking to achieve that earning power. These all defined in annual reports. And next is industry related data. Industry data related contains information on broad and specific industries across the globe. Industry data contain information on broad and specific industry across the globe. Total data, and the data include general industry statistics such as industry name, industry code, companies within the industry, number of employees, and forecasted market value, everything. Access to news. From news we can get some details about the bank or financial institution data, and the MS Excel for fundamental calculation. This is the Excel sheet. So in this sheet, using all the tools I've already given, I've already described. Through this, we can conclude about the bank's present financial situation. Next, how to perform banking stock analysis. We already defined all the points. What is called net interest income, how it is calculated, net interest income, net interest margin, cost to income ratio, net profit, return on equity, and total advances, total deposited. Total advances means total advance is an important metric to look at because the bank's primary earning comes from the assets. Advances are loans given out to customers, and hence it is considered as asset in the business and one of the key part of banking stock analysis. The rise in assets and rate of rising will tell us how the bank is growing its business. This is total advances. And total deposits. Total deposit means deposits form a major source of fund for the banks. Banks accept deposit in the form of term deposit, savings, current account. Banks lend out of the deposit it receives. Hence, analyzing deposits number will tell us how comfortably the bank are able to acquire funds to lend. Next is loan to deposit ratio or credit to deposit ratio or CD ratio. Loans to deposit deposit is used for measuring the bank's liquidity. Loan to deposit used to measuring the bank's liquidity means how much loan bank disburses and how much deposit amount is from customers. The ratio, an optimum level of liquidity is considered good. A high ratio may indicate a possible liquidity crunch and low ratio indicates the underutilization of fund. Now already said of the casa. Casa ratio of bank is the ratio of deposit in current and savings account to total deposits. That means how much total cash amount deposited, amount collected from current and savings account. You know, I already defined you. Again, a higher casa ratio is desired because banks give a low rate of interest in savings account, 3 to 4% deposit, and no interest in current account deposits. As you know, a casa ratio indicates a lower cost of fund. Fine. Now come to the gross NPA. I already defined somewhat, just for overview. A loan asset becomes non-performing when it ceases to generate any income for the bank. Gross NPA are the total loans classified by the banks as non-performing. Higher NPAs are the total loans classified by the banks as non-performing. Higher NPAs are adverse for the banks. This should be checked to determine the asset quality of the bank. The gross NPA ratio is a ratio of gross non-performing asset to gross advances. And what is net NPA? Net NPA is gross NPA balance in the interest suspense account. Basically, what I'm telling you, net NPA is gross NPA minus total provisions. And what is gross NPA? Gross NPA means balance in interest suspense account, DICGC or ECGC claims received and held pending adjustment plus part payment received and kept in suspense account plus total provision held. Everything is gross NPA. Net NPA ratio is a ratio of net non-performing asset to net advances. And already given you the PCR is a ratio of total provision balance of the banks to gross NPA. PCR ratio indicates the extent to which bank has provided for the weaker part of its loan portfolio. A high ratio suggests that further provision to be made by the bank in the coming years would be relatively low unless the GNP rise at a faster rate. And now the CAR already defined, and now come to the last point, and that is what are the key takeaways for performing banks stock analysis. One is peers. Peers means this ratio should be compared with peer banks and the industry average to decide the position of a bank with respect to its competitors and whether one should invest in that particular banking stock or not. So you cannot compare bank stocks with metal stocks, bank stocks with IT stocks. Different stocks are different type of ratios. When you compare with bank stocks, you should compare it with another bank. Like HDFC Bank, you can compare it with ICICI Bank or HDFC Bank to Kotak Mahindra Bank. These are the peer ratio you should compare, peer to peer. Next is economic slowdown. Economic slowdown is a loan business broadly imitates India's GDP mix by catering to the consumption theme. A slower the expected pickup in India's economic growth or a slowdown in job creation coupled with a sharp rise in interest rates could affect demand for retail loans and merchants. That means economic slowdown is totally related with banks business. So if in economic slowdown, when there is a less job is there, some jobs are those, some are losing some jobs, job creation is not done, slow down everything, then it is sharply affected bank business. So this is another key takeaway up to mind. And last one is a regulation. Based of impact of the Banking Regulations Act. The banking industry is highly regulated by the central bank. The regulator decision regarding various aspects like maintenance of cash reserve ratio like CRR, statutory liquidity ratio, SLR and repo rates affect banking businesses. That is an interesting point. When these regulators are continuously checking continuously under the supervision of RBI, Reserve Bank of India, and the Reserve Bank will be constantly regulating, constantly checking the total different metrics of the bank. and if any situation, if the just for example inflation arises, or in that cases they fluctuating the interest rate for liquidity problem solving, and different type of problems has been solved by the central bank through some regulative ways, through CRR, through SLR. I will discuss later all the things including repo rates. Okay friend, now we are in the last phase in banking fundamentals part 2. We already discuss all the parameters, we already discuss everything including all are in just overview part. We discuss about the fundamental analysis, the tools used, and then we used the EPS, P ratio, return on equity, price to book value, PB ratio, beta, price to sales ratio, and next we also discuss about return on equity, total advances, total deposits, CD ratio, casa ratio, GNP, NNP. We'll discuss all the points, and this is the basic overview of total details of banking sectors, banking stocks, and in future we will discuss one. Thank you very much. Please like and subscribe.